Did the Fed break something? And if they did, will they cowboy up and pull the trigger on enough rate cuts to stop the bleeding? That's the question investors are asking this weekend, on the heels of a roller coaster week that saw sentiment shift from the glass is half empty to half full and back again. Investors were euphoric during Jay Powell's press conference Wednesday, driving up the S&P 500 1.6%. A day later, stocks figured out what bonds have been hinting at for weeks. The Fed will cut rates, but it might be for all the wrong reasons. Soft landing? Forget the soft landing. Just get the plane on the ground. Brace for impact. Welcome to the Money Runner. I'm David Nelson. I've put up the same chart for the last few weeks showing the Fed funds rate for the last half century. Every time the Fed embarks on a cutting cycle, a recession follows. Why? Because if history's any guide, by the time the Fed starts cutting rates, it's too late. The damage is done and the economic downturn begins. The only time that didn't happen was 1984. Be careful what you wish for. Investors cheered last month's CPI, coming in better than expected. Higher rates had helped bring down some of the highest inflation numbers seen in the last 40 years. All the more impressive because monetary policy isn't getting any help from fiscal policy. Washington still wastes our money, picking winners and losers. We saw another example of that last week when Intel, the beneficiary of up to $8.5 billion from the President's Signature Chips Act, cratered, announcing massive layoffs on the heels of a bad quarter and even worse forward guidance. Intel has missed almost every technology shift in the last 2 decades, yet they're the firm that got the most money. Reminds me of another failed government venture when the U.S. Department of Energy provided a loan guarantee to Solyndra in the American Recovery and Reinvestment Act of 2009. Ultimately, we, the taxpayers, took a loss of $535 million. Now take that and multiply by 15. Before I get deep into the weeds on policy, needless to say, the Fed's job is made that much harder trying to offset unsustainable debt and deficits that are indeed inflationary. We got all built up last month, excited that the long talked about rotation and broadening of the stock rally was finally taking hold. Small caps rocked, outperforming mega caps as investors bought into the narrative that lower rates would indeed be supportive of smaller companies, more in need of credit and debt. The outperformance was massive. In fact, so large that in the space of just a few weeks, the valuation gap between the Magnificent Seven and small caps had all but collapsed. There were other forces at play as well. Money coming out of large cap companies tied to AI wasn't just to feed the rotation. There was real concern that the AI trade had run ahead of fundamentals, forcing investors to rethink positions. We knew the technology was going to be expensive, but it is the mismatch in timing that is causing the most concern. The buildout of AI infrastructure, including data centers, large language model training, chip manufacturing, etc., is outpacing the adoption. And that's showing up in earnings reports of some of the largest AI hyperscalers. Alphabet, Microsoft, Amazon, and Meta all reported increased CapEx related to AI projects, sparking fears that margins and profitability would be hit. However, Meta is spending $37 to $40 billion, but is already seeing the benefits. Better able to target customers with new AI tools, the top and bottom line gets a boost almost immediately. While the S&P 500 is off less than 6% from the highs, underneath the surface, the trading is frantic. The Russell 2000 was getting close to catching up to the S&P year-to-date. And while the last 2 trading days were a challenge for many stocks, the Russell was torched, down more than 6% following Wednesday's Fed meeting. Smoke signals of an approaching recession are popping up everywhere. Last week's PMI manufacturing print was the lowest this year and above 50 only once since 2022. It took a while, but the BLS employment data is finally starting to roll over. Friday's report on July jobs came in at 114,000, well under the 160,000 expected. Even Warren Buffett may be seeing a recession ahead as he sold $3.8 billion of B of A shares since mid-July. Of course, the bigger news coming out of the Berkshire report this weekend is that he slashed his Apple stake in half. Some will say the Oracle from Omaha is selling for tax reasons, as a Democratic win this November could usher in higher cap gains taxes. But he could also be selling out of fear that an economic slowdown is about to unfold. In the end, Apple's a consumer-driven company, and in many ways, it is a consumer staples company. But even Apple isn't immune to an economic slowdown. The sale of BAC, that's more telling. Financials were down more than even tech on Friday, and most of the sector was deep in the red. Hard hit were consumer finance companies, including American Express, Synchrony Financial, and Wells Fargo. Sector positioning is also screaming slowdown, or something worse. Utilities have quietly climbed all year, and now by a nose edge out communications as the best performing sector year to date. Think the consumer isn't rolling over? In dead last is consumer discretionary. All of the above points to anything but a soft landing. But none more important than what we're seeing in credit markets. The last time we saw a fall like this in 2-year Treasury yields was during the mini bank crisis of March last year. Silicon Valley and signature banks failed, with others on the brink. And if history's any guide, the Fed is already behind the curve. Forget a 25 basis point cut in September. If the Fed is going to make a statement, make it big enough to move the needle. Fed fund futures are already pricing in a September cut of 44 basis points. Translated, that means cold hard cash is betting there's an 88% probability of a 50 basis point cut. Being behind the curve isn't new for the Fed. And like I said earlier, in the last half century, the Fed was almost always too late. The good news is that with the current Fed funds at 5.5% and real rates close to 3%, they have a lot of leeway to ease policy. The unknown and, of course, overriding question is, have they tamed the inflation beast? Unknown. And you can bet all eyes will be on this month's PPI and CPI reports coming August 13th and 14th. Balancing the Fed's dual mandate of price stability and employment is about to get a lot harder. They may have to widen their band of thinking and live with a little more inflation while accepting higher levels of unemployment. A lot to digest this week, I know. We all have a lot of work to do. As always, if you like this pod and you'd like to see more, please hit subscribe. And don't forget to visit my Substack site, dcnelson123 at substack.com. I'm David Nelson, and this is The Money Run.